stare at one of those financial charts and it just looks like a total mess? Just a crazy jagged line going all over the place? Well, we're going to fix that. Today, we're diving into how to decode those charts. We'll give you the basic tools of what's known as technical analysis. Let's jump in. Yeah, I mean, look at this. To most of us, this is just random noise, isn't it? A big old jumble of ups and downs. But here's the crazy part. Professional traders look at this exact same chart and they see opportunity. So what's their secret? How do they even begin to guess where that line is heading next? The answer, believe it or not, is pretty simple. They look for patterns. See, they're not just tracking numbers, they're tracking people. The whole idea behind technical analysis is that human emotions, fear and greed, are what drive the market. And those emotions create patterns you can actually see on a chart. The trick is just knowing what those patterns look like. And that's our game plan for today. We're going to start by, decoding the chart itself. Then we'll get into the floor and the ceiling. After that, we'll talk about identifying the trend and even how to spot trends within other trends. And we'll wrap up with a super important tip, how to avoid something called a false breakout. By the time we're done, you'll have a whole new way of looking at these things. All right, section 1, decoding the chart. Let's get into it. You can think of this whole thing like learning a new language. We're not trying to make you fluent today, but we are going to give you the basic vocabulary to start understanding what these charts are trying to tell you. Okay, tool number 1. This is maybe the most important concept of all, the floor and the ceiling. We're talking about support and resistance. And honestly, the best way to think about it is like a bouncy ball in a room, right? It's got a floor it bounces off of and a ceiling it hits. And on a chart, it's pretty much the same idea. Support, that's your floor. It's a price level where buyers tend to jump in and push the price back up. And resistance, that's the ceiling. It's where sellers usually take control and push the price back down. So why do these floors and ceilings even exist? I mean, they're not magic, right? Well, it all comes down to market psychology. These levels are basically points of market memory. They're price levels where a whole bunch of traders in the past decided to either buy or sell, and that collective action creates these invisible barriers. Let's break down what's happening in people's heads when a price hits that ceiling, that resistance. Okay, so first, the buyers are feeling good, they're pushing the price up, but as it gets close to a previous high point, a couple of things happen. The people who bought early, they start thinking, hey, time to take my profits, so they sell. At the exact same time, other traders are looking at that high price and thinking, whoa, that's too expensive, I bet it's gonna fall. So they start selling too. All that selling pressure hits at once and bam, it overpowers the buyers and the price heads back down. The ceiling holds. So how do you actually spot these levels on a chart? Well, you're basically playing connect the dots with the peaks and the valleys. And here are a few rules of thumb. The more times the price hits a level and bounces off, the stronger that level is. Also, levels that have been around for a while, they tend to be more significant. Oh, and here's a really cool part. When a price finally breaks through a ceiling, that old ceiling often turns into the new floor. It flips its role from resistance to support. All right, so we've got our floors and ceilings down. We can see the boundaries. Now let's add our second tool to the mix, which is all about figuring out the overall direction of the game. We're talking about identifying the trend. So what is a trend? It's really just the general direction the price is moving over time. And it's never a perfectly straight line, right? It's more like a series of highs and lows that are all kind of marching in the same direction. First up, we have the bullish trend. The easy way to remember this is to think of a bull, with its horns thrusting upwards. So bullish means up. On a chart, this looks like a clear pattern of higher highs and higher lows. It's like climbing a staircase. Each step up is higher than the last. And the opposite of that, of course, is the bearish trend. Just think of a bear swiping its paw down. So bearish means down. This is where the chart is making a series of lower highs and lower lows. The momentum is clearly taking it downhill. And the third one? That's the sideways trend. This is basically when the market just can't make up its mind. The price is just bouncing back and forth between a pretty clear floor and ceiling, not really going anywhere new. It's in a holding pattern. Okay, but how can you be sure you're seeing a real trend and not just a random blip on the screen? Well, a lot of traders use what they call the rule of 3. Basically, you want to see at least 3 solid points of confirmation. So for an uptrend, that would be something like a high, then a higher low, and then another higher high. That gives you more confidence that a new trend is for real.
All right, now let's get into a more advanced idea. And this is where it gets really cool. The thing is, trends exist on different timelines all at once. It's kind of like those Russian nesting dolls. You might be looking at a yearly chart that shows a nice smooth uptrend, but if you zoom into a daily chart for that same period, you might see a bunch of smaller up and down trends inside of it.
This whole idea was laid out by a guy named Charles Dow. He broke it down into 3 types. You've got the primary trend, that's the big one, the main direction over months or even years. Think of it like the tide coming in. Then you have the secondary trend, which is like a wave going against the tide for a few weeks or months. And finally, the minor trend. That's just the little day-to-day ripples on the surface. So why does this even matter? Well, here's the pro tip. The most powerful trading signals happen when all 3 of these trends are pointing in the same direction. Imagine the main tide is coming in, the wave is moving with the tide, and the little ripples are also heading in the same direction. That's a much stronger signal than if you were just looking at one of them by itself.
Okay, and for our last section, we have a really critical warning. This is one of those things that often separates beginners from the pros. So picture this. You spotted a nice channel, you see the price punch right through the ceiling, time to jump in and buy, right? Well, not so fast. We need to talk about the dreaded false breakout.
So does a breakout always mean a new trend is starting? It's so tempting to say yes, isn't it? It looks like a huge green light, but the market can be tricky, and it absolutely loves to pull a fake out. And that's what we call a false breakout. It's when the price just pokes its head above that ceiling or below that floor. It tricks everyone into thinking a new trend is starting, and then it snaps right back into its old pattern. It's a classic trap, and it catches a lot of people. So, how in the world do you tell the difference? Well, a false breakout is usually really quick. It pops out and then immediately ducks back in. It tells you the old trend is getting weak, but it's not over yet. A true breakout, on the other hand, has follow-through. It breaks the line, and then, remember our rule of 3? It starts building a new trend on the other side. That's when you know the momentum is really shifted. And this really brings us to the most important takeaway of the day. Technical analysis is not a crystal ball. It will not predict the future with 100% certainty. Every pattern, every line you find, it's just a clue, not a guarantee. It's all about playing the probabilities. The best traders use all these tools together, looking for situations where multiple signs are all pointing in the same direction. So there you have it. You've got the basic toolkit now. You can look at one of those crazy charts and start to see the floors, the ceilings, and the direction of play. You can spot the battlegrounds. So the question to leave you with is, now that you have this foundation, what other patterns are you going to start looking for next?